comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm. Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ Law Firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Hey there, folks. Welcome back to another episode of State Tax Talks. I'm your host, Joe Tantillo. Today is part 2 of our series on tax considerations for buying and selling a business. I'm joined once again by my colleagues, Dan Kelly, Bill Turkovich, and Chris Doyle. And we're going to pick up where we left things off last time. The PTAT must add some complexity in terms of the timing of the sale, I guess, depending on what the timeline is and what time of year it is, especially with New York transactions, just because of the election dates. I have to imagine that can create some stress or some.
Is New York the only state that has that?
Well, there were one
election
two.
mechanic?
One or two.
So for the listeners who don't know what the hell we're talking about.
Unless you listen to the episode on PTAT elections featuring Chris Doyle and Liz Pascal, which you should download now.
Exactly, because Liz knows what she's talking about. I, on the other hand, have already indicated that I give opinions without any facts. The PTET election in New York is March 15th of the year that you want it to be effective. So if you want it to be effective in 2025, you've already blown it because we're sitting here on April 30th, which is after March 15th, even in my calendar. And you've missed the election opportunity. There is a proposal before the legislature now to change that. Most other states, it's a year later. It's you make the election when you file your tax return. So for 2025, you make it on March 15th, 2026.
Which makes so much more sense, but,
Right, because then you know if you need it or not, right?
Yeah.
So, and look, we haven't really explained what PTET is and why it exists. And I don't know if we want to force people to hear the Chris Doyle, Liz Pascal podcast, or if we should explain that now a little bit.
You can explain it now, Chris. It's always good to refresh our listeners on these topics.
So when they did the FTCJA at the end of 2017, they got rid of the state and local tax deduction to the extent that it exceeded $10,000, the so-called SALT tax or SALT limit. And that was a problem for people that live in high tax states like New York or California or, Illinois. Those folks, those states are full of really smart folks, and those really smart folks figured out a way to get what should be a state tax deduction if they owned a flow-through entity like an S corporation or a partnership. And that was to have their states pass laws called pass-through entity taxes or PTETs. And what happens is that if you're a partner in a partnership or an owner of an S corporation, the entity will pay your state and local tax at the entity level and then give you a credit for, on your personal tax return. So essentially you've advanced the tax responsibility to the entity instead of from you. You no longer need an income tax deduction on your personal tax return because the income that has flowed through to you from your flow-through entity has already been reduced by the amount of PTET that it pays. That's it in a nutshell.
So basically, it saves you some money at the federal level.
It allows you to deduct from your federal income the amount of state and local tax on your income from your business.
And I think, Joe, why we're talking about that here is right. If you're doing a straight stock deal, you own Joe S Corp, you sell Joe S Corp stock, there's no ability to make a PTET election there. So you're paying full freight of the state tax that you have to pay. Whereas if you do an F reorganization, you have an S Corp holdco that's selling the target. So the tax and the gain that's going to flow from the sale of target is going to hit your S Corp. And if you have a PTET election in place there, that's where you get the benefit of being able to take the deduction that you wouldn't have had on your straight stock sale.
Circling back to the question that kicked off the deeper explanation of what PTET is on the timing piece with New York and what is the other state that has the early election? I can't remember off the top of my head.
Wisconsin, maybe?
Something like that. Midwest. But I imagine that creates some complexity if the sale is happening at a time when the PTAT deadline is either imminent or maybe it's just passed and it hasn't been thought of. So, part one of the question is, what kind of complexity can it create for a transaction if it has not been considered far enough in advance? The second part is, are people talking about these state level issues early in the deal process?
So I would say, Joe, there on the first one, it's really only an issue if the company, again, we're talking S Corps here, if the S Corporation historically has not made, it's in New York, historically has not made the PTAT election. If it did make it for the existing company, New York has guidance out there that the holdco that we talked about that happens in an F inherits it. So it's really only an issue, and presumably it's New York and then that other state that Chris mentioned, if they historically didn't make one and they're scrambling to make one, or say the deal, they don't make it, the deal doesn't get into a letter of intent where there's actually a deal moving forward until June, say. That's where I think you have that problem. And we hear folks going out and trying to find another entity that has one in place to try to make that work. Really not a very successful endeavor, but you're otherwise out of luck if you want to do that deal that year. Otherwise, you got to wait till the following calendar year to fix that issue.
Right.
And I think on the federal side, given how much we work with our state and local tax group, we're very attuned to this. So I think that's typically something we're representing a seller that we're putting in front of them first time. We're having the tax folks talk with the sellers. It's these issues so that we're at the forefront of it. And I think that's something that, we're uniquely situated given the SALT practice here to be able to raise.
Yes. Outside of the Hodgson-Russ context, because we are very diligent and we have our tax people talk to one another, it's kind of leading into our next topic, which is going to be the multi-state due diligence process and general awareness of state and local tax consequences during the transaction process. We definitely see it on our end in the audit context, where there are various state tax consequences and apportionment consequences from these different types of transactions, where it's apparent that either the issue has not been vetted at all, or perhaps not vetted by someone with an intricate knowledge of various multi-state tax rules. And I guess this is for the whole table. Do you think it's a fair statement to say that sometimes the SALT tax considerations get overlooked in the transaction process?
I think that it's a good question, because the first question might be, well, how do you define the transaction process? Like, what is the transaction process? When does it begin? When does it conclude? So I think for many taxpayers, the transaction process begins in some cases months or years before you actually pull the trigger on, signing an LOI or kind of closing a transaction, closing a deal. And part of that, kind of preparation, thinking about the timeline, thinking about an exit, thinking about, who a buyer might be, contacting a banker, this is from the seller side of the table. Part of that may also include state and local tax compliance, may include, kind of review of operations, may include, review of the kind of checklist of things you might go down, looking at income tax, sales tax, withholding tax, entity structure. There's frankly dozens of taxes depending on how complicated your business is or where you do business. And so maybe state and local tax can be perhaps overshadowed or overlooked when you're kind of like in the heat of a deal negotiating, because, you might be talking about top line things like cost or employment agreements for key executives or other key issues. And you might not be worried about, kind of the state and local tax perspectives, because they will be what they will be. Mm-hmm. But I do think if you kind of spread the lens of what a transaction is and kind of when it starts and how it begins, many companies and many businesses are looking at it from the perspective of, do I need to get in compliance, or do I need to kind of check my, state and local tax obligations relative to my goal of selling my company? So I think from that perspective, it's often not overlooked. I think companies are paying attention to it. If they're not, it'd be wise to, I think, because very often it does come up in a deal, in a diligence process or in disclosures or in other locations. But also, Bill, from the perspective of actually being in the negotiation room, as where SALT fits relative to other things that pop up.
I find that typically if there's a problem on a transaction, a lot of times it has to do with a SALT issue. Typically it's sales tax related or some tax like that, where that ends up being a big fight between a buyer and seller because there's real exposure, A, and B, their buyer and seller are at odds about how you're going to clean that up after the deal closes, which can lead to escrows, specific indemnities, things like that. So I actually find that more SALT issues cause pain during a transaction than federal tax issues. It's rarer, I would say, for a Fed tax issue to almost be a deal killer. But we've had transactions where some of the SALT problems have been so severe that they kill deals, which is somewhat, to me, I think it's somewhat surprising because a lot of times the plan that a buyer will propose in terms of an escrow or a voluntary disclosure process to clean up past sales tax noncompliance, where you have a seller that has taxable sales, typically that's not workable for a seller. They're going to try to fix it up themselves over a couple of years and try to resell themselves and not have that haircut. So there's a lot of tension, I feel like, in the SALT space on transactions.
I think it's really interesting that this is an area that can create tension. And actually, I hadn't even thought of it being a potential deal killer.
If it's big enough, yeah.
Yeah, I guess it makes sense. Your liability and potential exposure can be massive. We've mentioned sales tax exposure, but you can also have income tax exposure, and that could go back years and years. City and local tax exposure.
I think part of it is that everybody is sensitive to the federal tax issues because there's just one federal tax.
Right.
There's a federal income tax. And everybody knows what it is. And even the deal people that aren't tax people, they understand the federal tax issues because it's the same in every state. It doesn't matter. It's the federal tax. It's everywhere. I think that, in the states, there's 50 different states and there's 50 different rules. And if you've got a business that's taxable or the owners of which are taxable in, 15 states, you've got 15 different rules that apply.
Yeah, I mean, we've done episodes of this show on nexus and sales tax and income taxes. There's layers of complexity to every single state's rules, and like you just said, Chris, it's different from state to state in many contexts. And you can go and listen to those episodes for a more detailed discussion on this. But a lot of these companies are unaware that they even have nexus in these various states. Sometimes it is not, a purposeful hiding of the ball and them pretending that this exposure doesn't exist, but rather it's just when they come to the table to do these deals and the due diligence process begins and they start getting asked these questions. When they lift up the rug, they find out, oh crap, we might be pulled in by this state's, nexus rules. Maybe we were over the economic nexus threshold for sales. Maybe we did have a physical presence because we had, remote employee A working in this state for years and years. There's a lot of different ways that states can open themselves up to potential liability, and there's lots of rules to be aware of. So being attuned to the rules can kind of help prevent this instance in the first place. But I guess, we could do a whole series on making sure your business is compliant with various multi-state rules. But, we're talking about tax considerations for selling and buying businesses. So this comes up in the context. Let's assume the deal is not killed. I want to talk about the due diligence process. How do you go about finding, what these potential liabilities look like, quantifying exposure? How is that tied into either purchase price or monies that are put in escrow? There's, I'm asking a lot of questions in quick succession here. We could obviously go through slowly, but I think that, to the extent you do pull up to a deal and you find out there are all these potential huge liabilities that you didn't even know about, obviously it's got to be pretty alarming for a seller, pretty alarming for a buyer. What's the process for getting this cleaned up while you're still trying to actually get the deal closed and signed and agreed to?
I would say most of the time it's not something that's going to get cleaned up while you're in the throes of the deal. It's typically going to be a negotiation between buyer and seller about the process for rectifying this past noncompliance after the deal closes. So you end up with kind of robust discussions and robust provisions of the agreement dealing with potential voluntary disclosures. who's going to do them, who's on the hook for them, what states, things like that. And that can result in a straight purchase price reduction. I think it's more common where it would end up in some form of an escrow where you're holding back after some modeling by an accounting firm, typically on the buyer side, what this exposure looks like, potentially escrowing a portion of that, working through a voluntary disclosure process that's guided by buyer post-closing to help clean this up. And then, once you're through that process, you may have something released from escrow. You may owe more under indemnity. Because a lot of times, in the current transactional space, there's a significant proliferation of basically insurance, rep and warranty insurance. But if there's a known issue like this, it's carved out of coverage by that policy. So typically that's why you have an escrow that the seller and buyer are going to have to agree to. There's going to be a robust indemnity for this. But it can be a pretty big battle back and forth about the cleanup process. We've seen that play out numerous times on transactions on both sides because sellers are obviously trying to limit how much the whole thing's going to cost them, and buyers trying to clean this up as best as possible so that 3 years down the road, they're not, finding out about some obligation after it's a lot harder for them to chase dollars back from a seller.
Going back to your question, is your question, how do they figure out?
Yeah, just backing up, who bears the responsibility for determining these liabilities in the first place? Even before we get to the cleanup, how do they figure it out? How do they quantify it? Which side has to figure it out and report it? Do both sides have a right to, look at all the books and records and make sure it's accurate? I suspect that there's, pretty rigid processes here.
Well, it's the buyer that is the party that is most interested in finding the hidden liabilities, right? And the mechanical process is there's a digital data room created, and the buyer asks the seller to populate that with various documents. And some of the documents are pretty standard. Tax returns for the last 6 years, 3 years, whatever.
Depends, yeah.
Books and records like the financial statements for the same period of time, contracts with your 25 biggest customers, your withholding tax, your state tax apportionment schedule for sales. And, that's like the first thing that you look at is the state tax apportionment schedule, because it says you've got sales in Oklahoma, but we see that you don't file a sales tax or income tax return in Oklahoma. Why is that? And you start asking those questions to uncover whether or not there are liabilities. We see that you have a withholding tax schedule that says that you're withholding 95% of your employees, are in New York, but you've got an employee for whom you're withholding New Jersey tax. Are they performing services or doing something for the business in New Jersey, or is it just because they're living there? Those are the types of issues that you can uncover, or the type of facts that you can uncover that might lead you to ask more about particular issues.
Yeah, and if you think about it, Joe, a lot of times on transactions, you have the party that's doing this diligence that Chris mentioned. It's a large accounting firm. They typically have, or a law firm where they have SALT experts asking these questions, doing the follow-up, reviewing the materials, looking at employee censuses to see where people are, looking at sales by state. So, you have a team that's basically doing a full-blown audit with these questions to find these issues. So, to me, the chances of these not being discovered is pretty low, right? Like, these are pretty standard requests and diligence is pretty detailed. So I think more often than not, these issues are going to be found and you're going to have to deal with them throughout the course of a deal.
I was going to add the buyer certainly will do exactly as Chris and Turk described in terms of, in most transactions, do a robust analysis of state and local tax aspects of the company, as we discussed before, all types of taxes. The seller, for its part, also may be obligated to put its hand up and provide information with respect to known issues. So there's often disclosures that are required by the seller. If they have knowledge of a tax issue, it needs to typically come in and be part of that discussion, part of that deal room, part of that contract. So the buyer is left, to due diligence of all tax types, cross-border, state and local, pick a tax type, and then other, kind of, do you own the IP? Do you, whatever other diligence might come up in the process. But the seller, for its part, very often doesn't just kind of like stay mum. They come forward with information that they're aware of, and they put it into the, kind of the mix, and that becomes part of the discussion too. So really kind of when you're coming together and doing a full-blown diligence analysis, one side brings the information that it knows about, the other side analyzes that information, and then they meet to discuss what the consequences are there exposure points, how do those get resolved, as Bill said, either during or after, or in some cases before, if it gets put on ice to have things corrected, the transaction's consummated. Also, I admired the phrase pulling up to a transaction earlier, that like almost like, pull up to a restaurant or to a friend's house. Here, it's like, I'm going to get this transaction. I'm going to pull up to it. I'm going to make this happen.
That's what you got to do. Pull up with confidence. Get the deal paperwork signed.
That's what I'm saying. It's all about.
Can you guys tell I'm not a transactional attorney, listeners out there? Comment. Give us 5 stars if you think I'm not a transactional attorney.
I'm judging your terminology here, Joe.
So, one of the things I want to talk about kind of specifically on this episode that has come up is, New York's 1060 rules. We've been talking a lot about S corps and EFRI organizations and 33H10 elections. I mentioned the 1060 rules for sales of partnership interests in this section, not to necessarily get into the specifics of those because we just did an episode on taxation of partnerships and non-resident partners, but more to raise the topic of, beyond due diligence and identifying potential liabilities that already exist. When you are the seller, when you're selling the business and you are taking into consideration what your various multi-state apportionment might be, how much due diligence is going into identification of strange multi-state apportionment rules? For example, New York's rules on 1060 partnership interest sales. And if you are, and I know this is a point that Chris wanted to talk about specifically, if you're not at the table and you're just an investor in one of these businesses that's going to receive a K-1 at the end and get some money from these transactions, what is the impact of these deal structures on you? And what level of voice do you have to raise these issues? Probably limited.
I think if you're, just a passive investor and don't have a majority interest, and all of the passive investors in the aggregate don't have a majority interest, there's very little they can do to put the brakes on the transaction.
Stop the sale. I own 0.5%.
Right. You own one share and you go in and sit into the shareholder meeting and ring the bell.
You even considered the implications.
To me, personally. So this is actually a very interesting evolving issue in state and local taxation. And that is the issue that's referred to as investee apportionment. And it's mostly for individual owners, so owners that are people. And it's mostly for entities that are flow-through entities, but not exclusively. In New York, if you sell a partnership interest and everybody else at the same time sells a partnership interest to a single purchaser, that partnership is no longer a partnership. It becomes a disregarded entity. If assuming it was like an LLC or a general partnership, it just for income tax purposes starts as a partnership in the hands of the sellers. In the hands of the purchaser, it's no longer a partnership. That is what Bill refers to as an asymmetric transaction, because under Revenue Ruling 99-6, the IRS says the seller treats that as if they're selling partnership interests, but the purchaser is treated as buying assets. So there's not a symmetry on both sides of the transaction as to how the transaction is treated. It's an asymmetric transaction.
I'm glad you like my term, Chris.
I think
stolen from the applicable treasury regulations.
Just because you stole it from somebody else, that doesn't mean that you can't own it. So, in any case, New York doesn't like asymmetric transaction because it gives, particularly for non-residents, it gives non-residents an opportunity not to pay any tax on the transaction in New York. So they passed a law that said that if you've got an asymmetric transaction like this, we're going to and the shorthand for that is a 1060 transaction. We're going to tax our non-residents based on their gain from the transaction multiplied by the business's apportionment percentage. How much of its income gets apportioned during the year to New York State. And that approach is being tested in a variety of different states. And I think we're just starting to look at the ramifications of that because, as you said, Joe, if you're Chris Doyle and have a 0.5% of a big fricking partnership and are 82 years old and have nothing to do with the operation of the partnership, you just bought an interest in it because your grandson had this great idea for making left-hand threaded widgets out of nylon. And it turned into this bazillion-dollar partnership. And yeah, your 0.5% interest is going to get you a big chunk of change. But finding out that, notwithstanding the fact that you've never lived in New York and really have nothing to do with New York, and the business is operated in Florida, because it has a tax profile that touches New York, the business does, you have to pay tax in New York for the very first time in your 82 years. That can be a shocker and not a nice one. So I think taxes like this, like investee apportionment taxes, are a little scary. Now, in some instances, it's a little bit more obvious. If you're an active partner in the partnership and your livelihood is tied up with the partnership, if you're a partner at Hodgson Russ and your main source of income is your partnership draw from Hodgson Russ, well then, maybe you should be tied if Hodgson Russ could get, my God, I would love this, purchased by private equity.
Wait till I'm in the partnership.
It would be, it makes sense to perhaps tax Chris Doyle and all the other active partners. But again, if you're, just an investor, passive, totally uninvolved in the management of the partnership, it doesn't make a lot of sense to me from a due process standpoint. What is the notice that you should think that it's possible that you could get taxed on this by a state that you don't live in just because you sell it? And it's like you sell a share of GE and all of a sudden you're taxed in 50 different states on some of the gain that you recognize when you sold a share of GE stock. That's ridiculous. But states are, states including New York, Massachusetts, there's a case called Welch in Massachusetts where Welch sold C Corporation stock, and they individually, and he was a New Hampshire resident, no income tax in New Hampshire. The business was primarily a Massachusetts business, and they said, "Yeah, we're gonna tag you on a chunk of the gain that you received on your sale of the corporation stock." And
their analysis was essentially that it was compensatory, right?
That is what they said, but then I think they, you have to drill down a little bit, but I think the apportionment methodology that they used was not the compensation methodology. It was the apportionment percentage of the business.
Mm-hmm.
Chris, have you seen, if you're saying more states are trying to follow similar rules as New York, are you seeing states, including New York, try to clamp down on what I view as really simple workarounds for this issue where the entity doesn't cease being a partnership, which are, tried and true on the federal side? We use the same things oftentimes to get around for older businesses, the anti-churning rules for certain intangibles under Code Section 197. Those seem tried and true on the federal side. I'm drawing an analogy there. They seem to be the same thing for this issue where you cause the entity to not cease being a partnership, whether that's a distribution out to someone so that that person keeps it, or you insert a corporate entity into it. Have you seen anything from the states where they're trying to clamp down on workarounds for this?
Not yet, but one could imagine that they'll, if it gets too stinky, they'll trot out the step transaction doctrine or business purpose or, some other judicially created doctrine to try to blow up a transaction if it gets too sticky. If you do it right, I would think that they wouldn't have a choice. For instance, you can avoid the application of 1060 if the partnership that's being sold remains a partnership. So if you've got two parties that are buying partnership interests after the fact, even if they're related purchasers, it seems to me that, that then you avoid the 1060 issue altogether.
Yeah, to me, Chris, like this, to your earlier point, Joe, about getting ahead of stuff and missing stuff, I view this issue now on the federal side, given how simple it is to avoid this issue, as this is kind of a big miss that a lot of folks encounter, that they don't think about this and obviously cause this result for the Grandpa Chris passive investor. But to me, the solutions to this of causing it to stay a partnership, they typically aren't causing much pain for a buyer or the other owners of seller. So to me, it seems like a very straightforward solution is to just get ahead of this, propose an easy workable solution, until states may clamp down on that. But this is almost like the well-advised don't have to deal with this. And if you're dealing with this, it's because there was a footfall by someone.
Yep.
These are the issues that keep us up at night, hoping that nobody misses it. All right, pausing once more because while we are very deep in the weeds now, there's still a lot more to get through, and we are unfortunately out of time. We're going to pick things up in the grand finale of this series, part 3 of tax considerations for buying and selling a business. Until then, this is State Tax Talks. I'm Joe Tantillo, and we'll see you real soon. Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans. The comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm.